Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for the week ending Sunday, January 21st, 2024. I titled today, Irrational Exuberance. Should we be worried about a bull trap? That is definitely probably a contrary opinion to what a lot of people are saying. And hear me out, I'll give the evidence for and against, and no, I am not a perma bear. My email address is hgsidoc@gmail.com. If you're new to my channel, please hit the subscribe, hit the alarm. No, I don't get paid a penny by YouTube, but if you do that, you'll find out when I post these. I've been doing this for a long time. I do it because I like to teach, and I've got some nice friendships out of it as well. Comment in the remarks section or use my email address. I'd be happy to respond. I don't have a website, although I do post a daily video that I'll mention as we go. And thank you for being here. Disclaimer, this is for education only. I'm a doctor, not a broker. I have an MD. I don't have any of the Series 7s and others that I would need to give you investment advice. So all I'm doing is providing education and my thoughts. I am independent. I do have tools within wealth charts. You'll see I'm using a lot of wealth charts today as we go, but I also have tools in TradingView, TradeStation, among others. All the tools I have, I've paid for, or I've paid somebody to create for me. Trading involves risk. You and you alone are solely responsible for any investment decisions that you make. I do post as frequently as I can. Those who saw me at Wealth Charts, the Wealth 365 this week, heard my story. I'm still very active. I'm in the C-suite of a company with 3,000 plus employees in the healthcare technology space. So I do spend a lot of my time away from my computer, and so I've had to learn how to trade on daily charts and to trade while working for a living. So I try and put out, when I have time, a video, and I do it 2 or 3 days a week at stocksanddocs.com. I do not personally keep the mailing list, but if you fill this out, you'll get a notice when I post them. So it was a 4-day week. It shows 5 days here, but because it doesn't adjust. But you can see that in the yellow are the major markets, and then except for the Russell, which was down 0.6, it was a super strong 5 days in the market. Now, if you look at something like the NASDAQ, you can see much of the gain came on Friday, and both on the composite and the Qs. And the Qs are leading the composite. The spiders finished up over the 5 days 1.3, and much of it came in on Friday. And the NYSE turned positive just because of Friday. And if we look at percent off the 52-week high, you could see the worst of these are the NYSE, which is off 1.2. Now, the Dow and the Qs, their 52-week high is a all-time high in the market. And the spiders ended the week at an all-time high, or they came off of it, but they set intraday an all-time high on Friday. So that is a very bullish start to the story. If you look at the sectors, you could see they were mixed with technology and communications leading, and the big laggard was utilities, energy, materials, and real estate. The Q Edge tool is one of, I've got, like many of you, I'm looking at, I've got about 5-6 screens in front of me. So if I was to stay at home all day, which rarely happens, especially we have back in the office mandatory Monday, Wednesday, and Friday, and if you're a boss, you got to set an example, so I'm in the office. But when I'm home, one of my displays is going to be a spreadsheet from which I take this. And that spreadsheet on a real-time basis is going to tell me, whoops, sorry about that, things like what are the sectors that are leading. And you could see real time is today's Saturday, so you only see the Fridays. And you can see on Fridays there is strength in real estate, IT, financials, pretty much everywhere, with the only lagging sector was the staples. Now you're probably thinking, well, that looks different than what you saw on this site or that site. And I just want to point out, this is you looking at very broad sectors, the S&P 1500 sectors. Over here, it tells me that 63% of the stocks in the S&P 1500 were below the midline of their Bollinger Bands. That is bearish. But when I look down here and I look at, or up here, the last day, 91% of sectors were up Friday, 81% of industries, and 74% of stocks. No matter how good the last 2 days was, and frankly the last 5 days was weak, 73% of sectors down, 59% of industries, and 55% of stocks. Over the last month, it's been a very challenging time in the market. Now, it's kind of a divergence right there that I just said that over the last month, it's been a challenging time in the market, and we've set all-time highs on several of the indices, including the S&P 500. Here's something that should keep you up at night, especially if you followed Ian Woodward or have been following me for any length of time. The skull and crossbones, the first one that hits is called as a Hindenburg Omen, but it's not confirmed. The second one that hits is a confirmed Hindenburg Omen. There has not been a major crash in the history of the U.S. markets that was not associated with a Hindenburg Omen. Now, traditionally, the Hindenburg Omen is only calculated on the NYSE, but if you think about it, if you go back 100 years, 150 years, probably didn't have the other indices that we have today. So if we look at a concern is we're at all-time highs here on this composite, which is combining the NYSE and the NASDAQ, but my goodness, we had a confirmed Hindenburg Omen hit on Friday. All-time highs, Hindenburg Omen, and typically I think of the Hindenburg as being the pros trying to get out and us amateurs buying it. And it's a very turbulent time in the market. We have to have new highs and new lows be and above moving averages. And I think that this has to be a concern. You can see that the small caps in blue have been toasted and have gone down ever since the beginning of the year. And it's been a market of growth, but it's been a market of narrowing growth. If we look at Friday, this is another one of the heads-up displays that I'll use, and this is Nick Drendel's very useful spreadsheet, and it shows the great performance on Friday, including ARKK, which has lagged for a while, and you could see a big turnaround. It was down 1.4 at one point of the day and closed up 1.36, and you can see this is a bullish thing. The indices close in the upper part of their range. The only indice of the bunch here that is trading below their 8 or their 21 or their 50 is ARKK, a lot of small cap growth names. And you could see that if you look at the stocks, the major indices, you can look here at some of the breadth, how many stocks are above their 5, their 20, their 50-day moving average, all the way to the 200. So clearly there's been some weakness over the last couple of weeks. And I guess the thing that bothers me the most is if we look at 1, 3, 6, or 52 weeks, we have a lot more new lows than new highs. And that concerns me. You don't usually see markets, bull markets, built upon lots of new lows. On the week, the leader was cannabis over the last 5, at least on Friday and over the 5 days. But you could see over 5 days there was a lot of weakness, and one that we've been following, the biotech was down again 3.7. China remains weak. The leader over the 5 days was cannabis, semiconductors, what we'll be spending a focus on in this session. So one question, again, I am not a perma bull. I am not a perma bear. In this part of the section, I feel like I'm reporting on the news. This is just the facts. In white, you have the 10-year on the left, you have the 30-year on the right. 30-year was up 3.7% this week, almost 5% higher on the 10-year. Yet the yellow line, the weekly S&P 500, sets all-time highs. Can the market keep rising with rates rising? That's a question you have to ask yourself. Is recession risk off the table? On the top, we have the 10 minus 3. And on the left, the 10 minus 2 on the right. We know that recessions don't occur when the yield curve inverts and gets below zero. The recessions occur every time we go back above zero. All right, and there can be quite the delay. Well, we're close to the zero line of the 10 minus 3, but boy, we're getting close on the 10 minus 2. Does that mean a recession is coming? Well, if you look at the Philadelphia Fed Diffusion Index, the Federal Reserve, we are above this minus 20, and you don't usually see recessions occurring when you're above minus 20. So right now we've got enough economic activity. And then I like to look at the BOA U.S. Yield Index Option Adjusted Spread, because during recessions you get money tightness, and we're not seeing that. However, something that I saw by one of the wealth chart speakers, David Bianchi, what is the health of the consumer? Up here it shows that all that money that we saved during COVID when we got those bonus checks from the Fed, we kept our paychecks going in many cases, and we didn't go out to spend money. Well, we've spent that off, and we are back now down to where we were 2018 levels. But here's the big concern. Look at our credit card and revolving debt. It's getting higher than it's been for 20 plus years. How do we manage that our savings are down, our debt is high, and we need a healthy consumer to keep buying? I think there's a concern there. And you start to add these things up. The rates are going up, the Hindenburg Omen, the credit risk, the fact that the yield curve might be coming back up, and you start having to wonder, how's that going to impact the market? Now, breadth was mixed. Stocks above the 200, stocks above the 40-day both came down with the market, despite the market going higher. But the short-term 13-week new high, new low actually went up. None of it's in a signal range. The buckets, as I mentioned, 2/3 of the stocks are below the midline in their Bollinger Bands in the S&P 1500. That is bearish. And there are very few stocks above or below. And this is a bearish picture, not a bullish picture. Now the Hindenburg, so we saw them on the market breadth tool from Sagar SuperiorProfit.co. What about the NASDAQ? In the last 6 trading days, we have had 3 Hindenburg Omens. I thought the NASDAQ just set an all-time high. No, it was the Qs, although the NASDAQ are right below their 52-week highs. When do you see Hindenburg Omens fire? Not at lows, you see them at highs. And the NYSE actually threw one on the 16th, which was Monday. So I don't think we're out of the woods. I really don't. I'm trying not to be a perma bear. Not saying go to cash and go short, but I'm saying be careful. Notice I struck the free out of the top of the poster. And then this really blew my mind. Imagine I could take all the stocks in the market. There's 11,000 in the HGSI data set, which I use to build this. And then EdgeRater runs it. And ERG is a combination of EPS rank, relative strength rank, and group rank. And high growth stocks typically have high ERG. And when growth is working, high ERG is working. Well, if you look at performance, percent gain by ERG, and you put only stocks $2.50 and 250,000, you get this weird pattern. If I throw out the head and the tail, yes, growth did better, but the majority of stocks were negative on the week. And if I put in all stocks, it's still the same thing. If I look down here, better earnings, you lost less. Better relative strength, you lost less. Group didn't help you. So I look at this, and I really have to ask my question. Where's the strength outside of semiconductors and the big cap tech? Know your news and earnings, not to make our world even more difficult. And this complicates everything. We got leading indicators, we got some PMI, some jobless, some GDP. And then Friday comes and we got the PCE complex. Remember what I said earlier? Fed is saying 3, the markets are saying 5. We got a Fed meeting around the end of the month on my birthday. Hopefully they'll give me a birthday surprise, or at least say nothing would be better, which is most likely, or nothing new. But what if that PCE comes in higher? There's some evidence that inflation is being resilient, not just in the U.S., but also in other parts of the year. of the world. So I think it's an interesting time. And oh yeah, I like to call the next 3 weeks earnings Lollapalooza. There are lots and lots and lots and lots and lots and lots of earnings. As it says in the lower right-hand corner, it's a judgment call to hold your stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. Well, we finished the shortened week at new highs. At least 3 of the indices are at or near new highs. The Russell's lagging. Mega cap tech with semis led. Look at SMCI. Look at NVIDIA. Divergence between the Fed verbal suggestion of 3 cuts versus the markets with 5. May versus March starts. Economy seems to be holding up. I'm seeing people talking about maybe there's no landing. What about that consumer debt? I mean, the PCE complex this week should be interesting. Markets seem to be ignoring the risk to the downside. There's another signal that we use in HDSI called the Phoenix. It fired multiple times last week. Again, that is a sign of market risk. So we're ignoring a lot of risky things. I do think the exuberance is starting to get irrational, but I also think it's challenging to short the markets at or near all-time highs. I'm narrowing my new long trades to the leaders only. I will honor my stops. When I looked at my 1,000 stocks last night, I found a lot of stocks to short. I don't usually find a lot of shortable stocks in a rip-roaring bull market. So that might be telling me something. So I'm neither a perma bull nor a perma bear. I just have to weigh the bull versus the bear case. It is not very clear here. Momentum certainly feels like we go higher, but I would not ignore the risk. Sometimes a picture tells the story, and there's 2 messages here. This is an old slide. The first message is the blue line depicts market bottoms from prior bears going back to the 70s. The heavier line is the Fed rates. You don't see markets bottom until the Feds cut rates. The market rates came down. The Fed has not cut rates yet. Typically, the markets drop for a while after the first rate cut because it signifies economic weakness. On the right just shows you that a bear market in a recession in red versus a bear market not in a recession in black are 2 different things. Imagine if we go into recession soon. What does that do? Don't fight the Fed is the message. Now, I do want to remind people who follow me, who have my tools, who were not at the Wealth Charts meeting, the Wealth 365. For all new and existing owners of my Wealth Charts Marketplace package, look for an invite to the Wednesday, January 24th, 7 to 10 p.m. Eastern Masterclass. If you own in other platforms and you reach out to me, forget, you don't need to reach out to me. I will post in YouTube sometime in the next week or 2 a similar program for my TradeStation and TradingView users. You'll see the next 30 minutes or so that I predominantly live inside Wealth Charts. Somebody actually asked during the Wealth 365 event, which I ignored, do you need Wealth Charts to do what I'm going to show you? No, you do not need Wealth Charts. However, it is much easier in Wealth Charts. It's simple. It is not a difficult platform to use, and I have to give kudos to Rob Hoffman for building a fantastic product that if you invest with Tradier, for example, and put $10,000 into Tradier, which was just announced, you will get free access to Wealth Charts. And I have an account at Tradier. They clear through Apex, and they're good. The other thing is, if you want my package of indicators, you have to own Wealth Charts, or at least lease it because you don't really own it, or get it free because of Tradier. And then I sell a package, and this is the link for that package. If you want to order it now, they may not honor it because the Wealth 365 is ending by the time you hear this. But if they don't respond or don't honor it, if you reach out to me, I can probably get you the package price. And if you want to come to um, the master class, you need to purchase it before. So if you purchase it, you'll get my marketplace indicators, my scanner, the trading, and codes for my sectors, industries, layouts, etc. And if on my package, which is not wealth charts, on my package, it's a one-time payment. I haven't usually said this and offered it outside of Wealth 365. I know people have asked me before, and I've always been able to get it for them. But since I'm doing that master class, a 3-hour interactive training on Wednesday, I thought, hey, why not mention it? All right. And then the last thing to reiterate is my daily analysis when I do them at stocksanddocs.com. And now, as it says, on to the charts. All right, we're back into wealth charts. And what I like to start with first on the weekend is going to my market timing signals. I really like this system because it really gives me a sense of to be in the market or not. What I've combined is learnings from reading Stan Weinstein's book and recently taking his master class and combining it with what I learned from Ian. And if price is above the 30-period WMA and the weekly bongo, this is weekly chart, is green, I'm long the market. So right now, I am long in each of the major indices, even though the Russell means you could be taking heat in small stocks, but we haven't lost the buy signal, and that's a pretty bullish looking hammer that occurred on the Russell on Friday. So this has not changed, and if you want to know, we've been long the market since November. We had a beautiful run in the markets between January and September, especially on the Qs. So this is something, and we'll talk about it and give you some of the evidence to support it at my master class. Market timing, I will sometimes look at daily charts, and the daily charts adjust my bullishness. And I did note on the daily charts that the daily bongos have gone red, but only on one have we dropped below the moving average, and that is on the Russell. So I think you can tell from what I've said thus far, I am still long. I am less long than I might be if I thought the market was going to go to the moon, which I do not. I'm cautious, and I let my stops take me out. I don't feel the need to chase here. If I go and look at the major indices, and let's just blow up the 5 minutes, you can see what we had this week. So let me get my days straight. 17th, 18th. So the 16th would be the first day. So it would be here is the 12th. So if you look at what happened on Tuesday, markets ran up and then they continued the same downtrend that we saw the prior week and didn't bottom until middle afternoon on the 17th. At what point the market started to move, and you could see what we saw on the 18th was a nice move higher, and then boy, a gap up, strong earnings, and the market just went up the rest of the week and really closed at the high or just off the high on the week. In fact, if you look at the S&P 500 on a daily chart, let's call some things out. This is the high of the market going back to January 5th, 2022, and you can see we have closed well above that high. So we are at all-time highs, closing highs on the S&P 500, although we did not close at the veriest high, so we'll be a little bit off the 52-week high print. There's nothing weak about this. The only question is how extended, and notice we're not that extended. It's only 80% on the high-low jump bar. If we look at the NASDAQ, you could, at least the Qs, a big gap up, closing just off the highs, And I suspect we're pretty much at all-time highs on the Qs. The Dow closed just off all-time highs, but has recently hit all-time highs. So how can you be bearish looking at those three? So that's the bull case right there. And none of them are so extended that they have to collapse. So if you want to be bullish, I think you still can be bullish. If you want to be bearish, I think even though I've said some negative things about this market, I've also said I'm still long. I'm just being very careful here. The Russell, is it reversing here? That would be nice to see. The Russell has really been a tale of two Darvas boxes. I'm going to show you this because you may or may not look at it this way. So we had a Darvas box that went on for most of this, started, say, here in 21 February, and we broke out of the Darvas box in November of 21, and we failed. And when we failed and came back in that Darvas box, we broke down, and lo and behold, we ultimately set, believe it or not, another Darvas box, with this line being the high and this line being the low. And then what recently happened? We broke above the Darvas box and we broke in. So I'm sure hoping that this does not equate to this. But when you have a pattern that formed over many months, and you break out of that pattern, and that means you should be going higher, and that pattern fails, you got to be careful. So that's one of the other pieces that I think concerns me about this market. Now, we know the VIX isn't going to be up because the markets were, that doesn't have the 19th, because the markets were so strong, and you can see the UVXY was down 3.6%. The dollar is up off of its lows here, as you can see. It's sort of making sort of a stepwise rise, but it's still way off of this Darvas box, which was problematic. And notice we dropped out of that Darvas box in November when the market turned around. When we look at commodities, gold bounced off the 50, was up despite closing lower than the open at 0.3 on Friday. Silver was down a bit. Oil is trying to break out, but oil is still down in a low pattern despite OPEC making multiple attempts to cut. Now, why is oil down? My guess is they're down because of concerns about the economic growth, and if we had a recession, that's not good for oil. If oil goes to start to recover here, and I heard some good arguments about why it might be a good time to be thinking about energy. I did notice that on Sagar's Trading Profitable YouTube webinar today that he was doing some looking at energy, and I think he actually took a trade. It's worth going to check it out. Just go to YouTube and just type in SAGAR stocks. Natural gas continues to drop. We don't worry too much about it. As we've said before, it's dead to me. Now, this is interesting. We had a shooting star in the 10-year at the 50. 10-year was up on the week. We talked about that. You could see 4 days here. Boom, 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 boom. Dollars creeping higher. 10 years creeping higher. Oil might be creeping higher. If those were parts of why this market has gone up, does that mean something to be concerned? We looked at the market signals. Let's look at some breadth. Now, what you can see here looking at the equal weight versus the cap weighted spiders. When cap weighted is leading, it points down. When equal weighted points up, cap weight's in control. The same thing here on the Qs. The same thing here looking at semiconductors. The market cap weighted SMH is way outperforming. Small cap growth versus the FANGs. The FANGs are outperforming. The Qs are way outperforming the IWM. And then the other thing I like to look at is just a ratio chart of the TLT bonds versus the spiders. And why? Because if I was to switch this, let's just switch it to a monthly chart. During periods of recession like 2008, 2009, temper tantrums in here, the 2020, you see the yield, the TLT will spike versus the S&P. It has not happened. There's no signal here Again, I am not saying a recession is imminent. I believe a recession is going to happen, but I'm a doctor, not an economist, so the doctor's view is it happens after the presidential inauguration in 2025. But that's just a view, and take it just as my view. S&P 500 sectors. Last week we put the star on technology, and boy, that was a star. It continues to be the strength of the market, so we'll move it up here. Looking at the rest of the market, the defensive stuff, staples, real estate, utilities, healthcare, all bad. Discretionary bad. And these are ratio charts of the sector versus the spider. Materials bad. Communications looks okay, and so does financials. In fact, some of the regional banks look like they're ready to roll. And boy, the other thing looks interesting is some of the asset managers. But it's a tech-driven market. I go into the stock scanners. Let's start with the heat map. And the first thing we notice on the heat map is, wow, it's all green. So Friday was a massively strong day in the markets for the S&P 500. If we look at the Russell 2000, you might see a little bit different. And you see still a lot of green, but the small cap stocks have some red in it. If we go to Wealth Scanner and we look at what's leading the markets. Now this top-down indices is a bunch of ETFs that I put together so I could look at what's moving in the market now. There are thematics, there are indices, there are sectors, and sometimes you'll see a pattern where a lot of a similar type will come up to the top. So let's take a look at what we see. Floating rate notes, I don't even talk about that. But insurance at 746. Look at the nice breakout here. Semiconductors, spider growth, semiconductors, Russell growth, technology, hack, and then everything else is either a bond or below 700. Now, you can get up to 860. We've actually improved a little bit, but what improved was the bonds. But hello, anybody want to say technology? Because there ain't nothing else there. Technology and growth are leading, so I would probably spend most of my time as I look at stocks, wanting to look at technology. Now, for those that are new to me, you see a lot on the charts, so let me walk you through them and tell you how I use them. So the big one here is a daily chart. On the daily chart, in green is a 17-day simple, in yellow is a 50-day simple, and in red is a 200-day simple. Simple, simple stuff. The triangles, green triangles or red triangles, are what is called my EMS signal, which is sort of an early movement signal. It's designed to be a quick signal that gets me in early and out soon. And you could see how early it would have got you in on this move from here and didn't get you out to up here. So it's a really nice supporting indicator. These circles, the red and green circles, are Rob's wealth signal, which is part of the wealth charts package. And I guess it's more of a diamond, is his new launch indicator, and the only way you get that is if you are a mastermind class of his, which is a lot of money, but it includes the 3-day live session in March, which to me was the reason to join. A simple volume chart, and then you have my dots. There are 4 dots at the top. The first one's not showing here, which is a gap. So let's put up SMCI because I bet it gapped up. So the fourth top dot is a gap. The second dot is volume. The third dot is breakout. The fourth dot is momentum. Then you have the yellow, which is a squeeze, and the green, which I want to scan for when they come out of the squeeze. When they're in the squeeze, they're going sideways. These little red and green dots are Wilder's PSAR. When it's green, it means the dot's below price, and bullish. When it's red, it's above price. Then you have 3 time frames of my bongo indicator, which is my trending indicator, daily, weekly, monthly. This red line is a high-low jump, and when it's above 95, I'm extended to the upside. When it's below minus 95, I'm extended to the downside, and we are extended here. I forgot these green dots here are green candle lows. The red ones are red candle highs. Blue is a simple, regular standard indicator in wealth charts, the relative strength versus the WMA, and I just set it as a, let's see, I think I had, yep, there's no settings, so I just use the standard. And then this here is an OBV, and what I may have to adjust it because I realized the other day that I may have changed the settings. OBV parameters, I use an EMA and 10, so that's what I like to see. What am I looking for? Well, this one's kind of obvious and gone, but I'm looking for a constellation of dots. Squeeze is great. I like pullbacks so that the short-term bond will go red to green, while the longer-term bond goes green. I like the relative strength to be above its moving average and breaking above it. Same with volume. On the right, you have the weekly chart, and I'm not going to talk much about this thing on the bottom. It's a test thing that I'm using to get a determination if it's useful to add to mine. And what it is it's from Dr. Keith Wade, and it's his HA Advanced Trend. He has some great stuff, and what he does with the Heiken Ashkin candles makes me always wonder, is it time to switch? It probably is. So that's my indicators. Now, if the ultimate setup for me is a pullback and an uptrend with dots, maybe I can scan for them. So let's go into my CAT scanner. Let's pull in technology. And let's look for, sorry about that. Let's look for stocks that have pulled back in an uptrend. Now, the problem is most of this technology is not pulled back in an uptrend, but let's just start with that one. So we have analog devices. So is it in an uptrend? Here's the weekly, certainly in an uptrend. Did it pull back? Absolutely. And here it's breaking out above the 17. Volume, breakout momentum. Why is it not a big gap up? Not as much gap as I thought it was. Here's this flip of the bongo. It's not extended, and relative strength and OBV are breaking above their moving averages. Autodesk. Beautiful chart. Uptrend, pullback, breakout. You got breakout momentum. Volume is not great, so that would be a negative. Relative strength and OBV look fine, not extended. Akamai. Again, another beautiful stock. Pullback, now breaking out, not yet extended. I don't have a whole lot of dots here. Let me rank my dots. Sorry. SMCI. This is the grandfather of moves on Friday. This thing was up like 100 points. So it fired everything. Launch, the EMS, notice my signal, the well signal, my EMS fired back here 110 points ago. Massive volume, relative strength and OBV look great, but boy, it's extended. My guess is this thing goes higher. The last several times it had big gaps like this, it did go higher. However, it wouldn't shock me for it to consolidate a bit before it goes higher. It went higher for the best reason. They came out with a big upgrade of their earnings. Texas Instruments, not as pretty a chart, not in a nice uptrend, so I'd probably go skip it. Here's that analog devices, looked fine. Celestica, this is one of these contract manufacturing companies. Beautiful uptrend. You had your pullback. There's my EMS volume. Breakout momentum coming out of a squeeze. Relative strength and OBV. I like the high-low jump. That one looks good. Fastly, this is one that's not way extended. Big pullback. And notice EMS and the well signal have fired. A little bit of a move up on Friday, 5%. Volume, breakout, momentum, relative strength, and OBV look good. Nowhere close to extended. I like that one. PayPal, this one has been going sideways for, well, it's been going down and then not really making much headway, but did it just change there? This is also one that I'm going to be watching on Monday. Big move up here, not much of a gap, closing above and moving above that 200, which could have been resistance. Look at the volume that's come into the stock. Look at all those green dots, multiple days of momentum out of a squeeze. Relative strength and OBV are high. Now, here's an issue with the high-low jump that's pretty obvious to me. When a stock has been going sideways for a little while, the high-low jump is going to contract because the distance from the moving average is small. This looks like it's extended by high-low jump, but when you're sitting right on top of the 200, you're not extended, period. So yes, it's had a big move off of here. I don't think I consider that to be extended. And I could just go down the list. I know that Informatica is another big leader with a pullback breaking out now. So how cool is it that you can just take a big list of stocks, whether it's an individual industry group or sector or the market as a whole, ask for a specific pattern and have it come right up to the top. Now, if you look at settings, I like 5 and 500,000. Some people would prefer a smaller number. I like options, so I just put a greater than or equal to 1 on liquidity. I just want to know if they have options. And then I want at least one bullish dot because, hey, I buy things that are bullish and I don't want any bearish dots. I give it almost 2 weeks to have flipped on the daily bongo. So if I want to find things that are fresher changes, I might lower that to 2 or 3. And then I require both the bongos to be bullish, and that's my basic scan, and you can see how powerful it is. Now, in a market that's run a lot, we might want to look for things that are, here we go, just big leaders. And so if I just run my dots, all I'm requiring here is dots. Nothing else matters. Take a look at Adobe. This one actually looks very interesting right here. Major uptrend is pulled back. It's sitting on its 50-day moving average. The 17 is below the 50, so you know it's not extended. It had volume breakout and momentum. Relative strength and OBV are starting to linger. This is one to me that looks like it's setting up for a run. Okay, anything else new here? Net appliances, net app. This one had a big gap up, pull back, and breaking out. Does this one not look like it's ready to run? I mean, the whole purpose to me of scanning is so you don't have to do what I did last night, which is look at 1,000 charts, but to develop tools that bring the type of stocks you like to trade. Now, I'm a top-down guy. I start with the markets. You know from the first half that I'm still thinking the markets are going higher, but I'm concerned. So I'm going to be careful. Then I want to go where the strength is. We know it's technology, so I've looked here. And then I'm looking for my favorite setup, which is pullbacks. Now, in some markets, I'm going to look for things that have just gone, well, I'm not going to buy things that I call rockets, but rockets are things that are just going straight up. I would love to be owning AVGO at $1,211. This thing was $860 back here in September, but it's kind of extended for me. So these are my rocket scan. Look at AMD. Wowzer, we talked about this one over the last several weeks. That's a rocket. All right, so I have anybody with momentum. I have rockets. I also have a scan looking for bottom poppers, things that have sold off hard. Now, why would I want to buy garbage now? So that's a problem. So I'm not sure I'd even use bottom poppers at a market at all-time highs. But ALGM was a really big leader that sold off. Now, I'm not buying this. They're below the 200. But if we were in a bear market and I'm looking for things that might emerge, I might look at bottom poppers. And I don't expect to find many bear retracements here, but I could also scan for things that are bearish stocks with bearish dots retracing into support. Now, why would I expect them? Because it's technology. Now, I have a list that I put together of stocks that to look at for bearish moves. And so I might expect here to find some, and this is something that I will certainly be looking at. Celsius broke below the 15, the 17 and the 50. I'd have to see if their earnings came out. But, it's probably not going to drop much below the 200. Maztec, a break below the 50. This would be interesting. It's sort of retraced here and is going down again. Again, I'm not ready to start shorting this market because I don't short all-time highs. But if I want to find stocks that are breaking down, I've built a scan for breakdowns. So it's not just a breakouts tool. Lastly, let's go back to my pullbacks and uptrends. And why do I like the pullbacks? They're less likely to be extended. And let's go into my combo buy list, which is a list that I put together of a lot of different people's lists from various sources. And let's run the dots and let's see if we, all right, so Ally, I talked about regional banks, Allied Finance, I think, whatever, Ally Financial. So look at this big uptrend, pullback, and a breakout. There's 4 dots, gap, volume, breakup, momentum, coming out of a squeeze, a PSAR reversal, daily bongo flip, not extended, strong relative strength, and strong volume. I love it. EDR, Endeavor Group Holdings. Run up, sideways move, looks like it's getting ready to move ahead, a gap up, clearing major moving averages. We looked at SMCI. The insurance companies look strong. Here's AIG, which actually survived after the great financial crisis when I thought it might not. Pull back towards the 50 and a breakout over the 17 with volume and momentum. Relative strength and OBV setting up. Haven't really done much yet. Builder. The builder stocks look interesting here, and I'm going to show you a couple of them. But builder is more of a sourcing stock, supply stock, high base, and a breakout with 3 dots. So volume, breakout, momentum, relative strength, and OBV looking good. MDC is a builder stock, if I'm correct. And you know what? Let me see if I can find something that I saw today that I haven't used before. Stock info. Nope, it's not called info. Info, symbol info. Okay, let's stick it here. So I got to make that red. Perfect. So it should somewhere tell me what it does. Oh. All right, well, I guess you're going to have to trust me. I could be wrong, but I think this is in the housing business. Home prices. Okay. So MDC had earnings on Thursday, big gap up. They held it. I can't buy this here. Look at the builder's housing supply, MDC. So what do I do now with Pulte Home? Basing, is it going to take off with earnings? Lennar. Remember, we got housing new builds this week, so I think these are interesting. They are come off of being extended, and something tells me housing's got its next leg coming up. So lastly, I wanted to look at one more I saw here that I wanted to bring up, and that is the stocks in the asset management. This is one that I happen to own. This is KKR. Doesn't pay a big dividend, but it's been a huge growth off the 200, which shocker occurred in November at the bottom. And this one looks like it's ready to run. This whole class looks interesting. So what did we just cover? I gave you about 18 minutes of pontification of the market. This is, and remember, doctor, not a financial professional telling you what he thinks. I think this market is risky. I do think we have irrational exuberance. Well, maybe it's not irrational, but it's starting to feel irrational. But we do have new highs, and I'm not going to deny that. I think the market goes higher from here, but I think at some point, it always happens, we'll get a correction. I just think it's probably sooner than later. So I think it's okay to nibble. Technology looks like the place to be. Communications looks strong. Follow the industry groups. I love that ratio tool in wealth charts. Going back to the person who asked, do I have to have wealth charts? No. I could probably open up 4 or 5 different programs. For example, TradeStation has my scanner. I built it for TradeStation and my indicators. But TradeStation doesn't do a great job of industry group analysis. HGSI does a great job of industry group and analysis, and I can come very close to my scanner there, but it doesn't have all the indicators that I use. Great program, and I love HGSI. All right. TradingView, I've built my indicators there. Great package. Scanning of proprietary indicators doesn't happen. So I have, if I put HGSI plus TradingView, HGSI plus TradeStation, or best HGSI plus TradeStation and TradingView, I can get equal to what I can do in wealth charts, except I still have to pay for data feeds in some of those platforms. I don't have to pay for them in wealth charts. It comes with my price. So yes, you can do it in other platforms. Wealth charts makes it simple. I appreciate what Rob Hoffman has done in wealth charts to support the people who follow me, and I really think he's made it easier. And I look forward to seeing my friends and students at the Wednesday night masterclass. Contact me at hgsidoc@gmail.com if you want to talk about ordering my package before that event. Have an awesome rest of the weekend, and after Michigan won the Natty, it's hard for me to watch football and care. But boy, there's some good football this week. Have a great weekend.